This video will provide a brief introduction to the three primary financial statements we'll be covering in this course. While firms may produce a variety of reports and schedules, these are the three most important statements that serve as the basis for communicating the financial performance of a company. The balance sheet, or statement of financial position, is a listing on a given date of the assets, liabilities, and stockholders' equity accounts. The income statement and statement of cash flows provide information for a period of time that tells how well the firm has performed during that specific period. Now let's look at each one more closely. The balance sheet is the primary financial statement in that all other statements are really just subschedules or are derived from the balance sheet. The balance sheet is defined by the accounting equation that states assets of the firm must be equal to the liabilities and stockholders' equity. This makes sense when you define assets as everything the firm owns that will provide a future benefit. These assets must be equal to the claims on those assets, where the claims come from the creditors and owners. This is very similar to how you might create a personal balance sheet for yourself. First, you would total up all your assets, things like cash, bank accounts, maybe a car or house, or any investments you might have. Before you get to keep any of those assets, you first have to pay off your debts, which are the claims by your creditors. Whatever is left over represents your claim on the assets, what we call stockholders' equity for a firm. This lists some of the more common asset, liability, and stockholders' equity accounts. Now let's see how the income statement is derived from the balance sheet. This happens in the stockholders' equity section through the retained earnings account. Retained earnings is the balance sheet account that captures any net income earned by the firm during the year. In other words, when the firm performs and earns a profit, that money belongs to the owners, and so their ownership interest increases via an increase in retained earnings and stockholders' equity. Note that when the firm decides to pay out some of these earnings to stockholders as dividends, then this will reduce retained earnings. So to summarize, retained earnings is a cumulative account that increases whenever the firm earns net income and is reduced whenever the firm pays dividends. Also, if the firm has a bad year and incurs a net loss, this will reduce retained earnings. Viewed in this way, net income is a subsidiary account to retained earnings and the balance sheet. This graphic shows how the income statement is linked to retained earnings and helps to explain the change in retained earnings from one period to the next. While income statements will look slightly different from firm to firm, this generic income statement lists some of the more common line items. You should take note that the classifications are intended to help the user tell the difference between revenues and expenses that are related to the firm's main operations, which is what leads to operating income or EBIT, and revenues and expenses that are not part of the firm's core activities, things like restructuring expenses, interest expense, and gains or losses on the sale of assets. After this, you usually get a subtotal for income before taxes, then income tax expense, and then your bottom line net income. Of course, different firms will have different revenues and expenses and different gains or losses, so you would expect to see a variety of different line items than what you see here. The third statement is a statement of cash flow and is designed to separately list the cash received and spent on operating activities, investing activities, and financing activities. Operating activities include any cash spent or received related to selling your product or service. Investing activities include any cash spent or received related to things like buying or selling fixed assets or intangible assets, or even any investments you might have made in other firms or businesses. And financing activities include any cash spent or received related to financing your business, such as selling stock or borrowing and repaying loans. Examples of cash flows for each of the three categories, operations, investing, and financing, are shown here. Just as the income statement helps explain the change in a particular balance sheet account, retained earnings, the statement of cash flows is designed to explain the changes in another important account, cash. Thus, you can see that there is a specific linkage among and between the three statements, and they each provide a slightly different but equally important perspective on the firm's financial performance and condition. Next, you'll have an opportunity to test yourself on the form, content, and differences between the three primary financial statements.